Okay, it's 7:03, so we're going to go ahead and get started, or at least 7:03 where I am. Good evening or good morning, everyone. My name is Alexia Kelly. I am the co-chair of the Low Emissions Development Strategies Global Partnership Finance Working Group. We're very pleased to be kicking off a new webinar series that the LEDS GP Finance Working Group is organizing, focusing on innovation in climate finance and NDC finance across the globe. This is the first of what we hope will be a series of interactive webinars and discussions facilitating peer learning and best practice sharing across the globe on some of these key issues. Tonight, our webinar is going to focus on accelerating NDC and scaling up investment in low carbon energy through blending finance. So very happy to have Bella and Jess from the Climate Policy Initiative joining us to talk about their new report that was recently released on different applications and approaches to blending finance globally. Before we get started, just a couple of housekeeping items. Make sure that this is, there we go. So first, we just want to say that the LEDS GP does not endorse or recommend any specific products or approaches. Information in the webinar is really featured on our website and is intended to serve as a resource for the members of the LEDS GP and other global practitioners active in low emissions development. We will be recording this webinar. We are in fact recording it now, and it will be uploaded to the LEDS GP website within a week. You've probably already figured this out, but there's a couple of different options for audio. You can either listen through your computer or listen by telephone. You're automatically muted, so don't worry about that. But if you do have questions during the webinar, and we'll be pausing after each presentation to allow folks to ask questions, please use the chat tab in your GoToWebinar control panel. So this big gray box over in your screen. I wanted to do a quick test to see if it was actually working. So if you go down to questions and open up that box, if folks could just type in the country that they're dialing in from into the box and send it to all, that'll both give us an opportunity to kind of see who's on the webinar and where folks are dialing in from, since we don't have time to do a full round of introductions with everybody. So just take a minute and navigate over to the questions tab, hit the arrow down, and then type in the country that you are dialing in from. Or you can raise your hand and we can unmute you if you have a specific question. Alex, you get the gold star for delivering first. Great, it's working. That's very exciting. I'm glad that Tia's calling in from the country of test question. So if other folks want to find their way over, great. We've got folks dialing in from Vietnam, from Jamaica, from the US. So just go ahead and keep working on trying to get your answers in. And hopefully that will enable us to both figure out how to work the test question and get that going. Oh, we've got somebody from Chile, someone from China. Wonderful. Tia from test question again. Great. So just a quick overview of what we're going to be talking about tonight. We will be providing a brief overview of both the Finance Working Group and the Low Emissions Development Strategies very quickly for those of you who may not be familiar with our work. And also going to be talking about the specific work programs that the Finance Working Group intends to undertake over the next 12 to 18 months. And then also just to provide a little bit of a level setting overview and presentation on some key finance concepts that we're going to be working with this evening and talking about over the course of our work here. Then I'll hand it over to Jess and Bella to present the findings of their recent blended finance paper. It's really a very nicely done paper that explores a lot of different approaches and strategies that are being deployed in blended finance. And we're going to talk a little bit about why blended finance matters in the first place. Just to give you a sense of both Jess and Bella's expertise in this area, Jess Brown is currently serving as Associate Director at the Climate Policy Initiative and supports CPI's work on global climate finance. Previously, Jess served as a Foreign Affairs Officer at the U.S. State Department, where she led all international climate finance negotiations on behalf of the United States government. And before that, she served as a research fellow for the Overseas Development Institute, where she focused her research on measuring, tracking, and assessing the effectiveness of international climate finance flows. Jessica is an internationally recognized expert and policymaker with 15 years of experience in environmental and climate change research, analysis, and consulting. And Bella Tonkanogi is a manager of CPI's climate finance team and leads the analysis and development of innovative climate finance instruments for the Global Innovation Lab for Climate Finance. She also manages projects focused on understanding the effectiveness of innovative finance more broadly, including a recent project with the Blended Finance Task Force on how blended finance can be more effectively deployed for clean energy, the subject of tonight's webinar. Bella previously served as a policy advisor in the U.S. Treasury, overseeing the agency's energy and environment investments in emerging markets. And I had the great pleasure of serving with both of these ladies during the Obama administration, so it's great to be working together again, and very excited to continue to explore opportunities in this key area. So for those of you who are not familiar with the Low Emissions Development Strategies Global Partnership, it was created in 2011, and it was during the time when we weren't allowed to talk about NDCs or INDCs because they weren't actually a thing yet. So the LEDS GP is a network of public and private practitioners and institutions that are working on the transition to a clean low emissions economy and the implementation of nationally determined contributions at the local, national, and international levels. LEDS GP has grown enormously since its inception. It now has over 118 member countries and over 350 different institutions all working on different pieces of the low emissions development strategy puzzle. There are also thousands of individual practitioners who are working in national or subnational governments that serve as individual members. As part of this, we have a global secretariat, which is housed at the Overseas Development Institute and the National Renewable Energy Laboratory. And then there are 4 regional platforms: Africa, Asia, Latin America, and Eastern Europe. And then 6 thematic working groups that are essentially content verticals that provide support to each of the regional platforms. So I co-chair the Finance Working Group along with the Ministry of Planning and Investment in Vietnam. And I also work with a variety of other partners through the regional platforms very closely on delivery of our implementation modalities. So what does the Finance Working Group do? We work to mobilize finance for the LEDS transition through public and private partnerships specifically. So since inception, our members have really identified working with and collaborating with the private sector much more closely as a key objective of their work. And so the work that we're doing is really focusing on how do we work together with the private sector strategically to leverage scarce public resources and to accelerate investment into low emissions development through peer learning and collaboration, targeted technical resources and input, and innovative public-private partnerships and dialogue. So we work together through a variety of in-person meetings and other webinars such as these, as well as regional platform meetings, virtual meetings through the phone to engage deeply on specific topics. This year, we're really focused on building up the Finance Working Group membership and advancing what we're calling communities of practice as a core element of the work that we do. And I'll tell you a little bit more about a couple of those in just a moment. We are also working to collaborate with and mobilize resources for early mover governments interested in piloting innovative financing approaches and strategies. So the LEDS is designed to be a member-driven and member-responsive initiative. It was created for developing countries to have a space to work on things that were important to them. And we have a variety of quick dispatching and responsive initiatives and tools and programs that can help provide specific support to countries that are moving things forward. And more specifically, we're really looking to mobilize investment and impact at scale. So the communities of practice are a relatively new thing in the LEDS GP. We've launched, I think, 4 of them now, or 5 of them over the last 12 months. And essentially what they are opportunities for developing country governments and practitioners to work together really intensively in a specific area. So they identify the key areas that they want to focus on and dig deep on an ongoing and sustained basis. The two that the Finance Working Group are most active in is an African mini-grid community of practice, which is looking to advance the application of mini-grids as a key energy access, climate change, and economic development solution across Africa. And the members have identified as priorities really looking at opportunities to access and facilitate financial flows and how to design effective policy and regulatory environments. And then finally, looking at best practice modalities. There are 9 member country governments of the African mini-grid community practice, including Nigeria, Kenya, Uganda, Tanzania, the Sierra Leone, and a couple of others that I'm forgetting at the moment, but have really been engaging. This is a picture from our last meeting in Nairobi, working together on very specific and deep kind of training and collaboration, including peer-to-peer exchange. In Asia, we recently launched a finance community of practice that is looking at opportunities to lower the cost and the risk of capital across the region with a particular focus on clean energy. So we're looking at blending capital as a core area of focus, hence this webinar and the time for it, as well as green bonds, working directly with green bond issuers to build their capacity and partnering with other key partners in the region and experts who are active in this space. Also interested in attracting private finance through key regulatory and enabling environments. I want to take just a couple of minutes to talk through some key capital markets terms, and apologies for those of you for whom this is remedial, but we wanted to make sure that folks were all starting from the same basic level. Really the question is, why are we blending capital and why does it matter? Why right now is blended capital such an important issue? And at the most fundamental level, it comes down to risk versus return. So as the private sector is thinking about specific investment decisions and opportunities, they're looking at 2 things. They're looking at the risk and the financial reward. Increasingly, they're also looking at the impact of those investments. But if we want the private sector to invest at scale in clean energy or any other opportunity related to the low carbon economy transition, we need to figure out how to deliver returns that are appropriately adjusted for the risk. There's 2 primary vehicles or channels through which finance flows, 2 flavors of capital, if you will, debt and equity. Debt tends to be lower risk and also lower reward. So you're making an investment, but you know you're going to get your money back and you're going to get paid back at an agreed interest rate over a fixed period of time. Generally, it's considered non-dilutive because it doesn't offer an ownership share, but you know how much you've lent and you know how much you're going to get back. Generally, companies are really only able to access this kind of financing once they are cash flow positive and or profitable. You have to be making enough money that you can service your debt in order for people to lend to you. Similarly, or I guess on the other side of the coin, is equity, which is capital that's invested under agreed terms at the corporate or project level and is generally invested in exchange for an ownership or right to an ownership share in a company or a project. Typically, this is used for earlier stage projects and also earlier stage companies, considered higher risk, but also potential higher reward. Finally, there's 2 primary channels that capital flows as it goes into specific opportunities, either at the corporate level, so both debt and equity flow through there, and the capital is generally used for growth of the company, marketing, personnel and hiring, equipment purchases, growing the team, et cetera. Or it goes in at the project level. And usually that's either an individual project or a group of projects through a special purpose vehicle to hold a number of projects in one specific legal entity. This can also be both debt and equity, and it's usually used to finance specific costs associated with the project. So blending capital, there's a lot of different types of capital out there, and there's an infinite number of variations and combinations of debt and equity that you see deployed in the market. But capital tends to move in specific ways depending on the type of investor, their risk tolerance, how long they want their money invested for, how much of a return they expect to see. So an institutional investor generally wants much longer, safer, more secure, but sometimes lower return in exchange for that security profile capital, whereas a venture capital is looking for quick turnaround, high growth, high impact, high risk, and high return opportunities. So understanding the different types of capital and how those different types of capital think about investment opportunities is critically important. And the blending is what happens when we try and work together and across the different types of capital to get folks to go just a little bit outside of their comfort zone. So I just wanted to provide one quick example of why we care about blending capital in a specific low carbon instance. And then I'm going to hand it over to Jess to provide some overview on their report. The microgrid, energy access microgrid market is a great example of a place where blended capital is really, really needed, because what's happened is that it's characterized by very early companies that are working in high risk environments. They are high growth, but they are also generally delivering infrastructure level returns, which means that there's a high capital expenditure, there's a high requirement to invest a lot of capital up front to actually build your microgrid. And then you're being slowly paid back by the people who are purchasing the energy over a period of 8 to 15 years. And so your overall return profile for that particular project is really not matched well with the type of capital that typically invests in early stage companies, which is venture capital and other sources of high risk equity. So what's happening is folks are taking different types of capital, grant capital generally, and they're blending it with equity and with debt to mobilize private sector investors into this sector much earlier than they would be able to justify coming in based on the risk reward ratio. So there's a lot of innovation happening in this space right now, and it plays a really important role in helping us accelerate investment more broadly. So with that, and this is a couple of examples, I'm not going to go into detail because Jess and Bella are going to give you a lot of examples. I'm happy to take any questions on anything, clarifying questions, and we'll have time for discussion at the end. So does anybody have a question? You can also raise your hand. So if everything is clear as mud, great. Seeing none. Jess, do you want to get going on talking about the importance of blending capital and some of the research that you guys did in looking across the variety of blended capital opportunities and tools that have been developed over the last little bit?
Yeah, that would be great. Thanks so much, Alexia. I hope everyone can hear me clearly. Thanks to everyone so much for joining our webinar today, and we're very happy to be talking to you about this really important subject. So in January, Climate Policy Initiative published a report which focused on lessons and opportunities for blended finance, specifically in the area of clean energy and further specifically within developing countries and emerging economies. This report was commissioned by the Blended Finance Task Force, which is part of the Business and Sustainable Development Commission. And our report was actually one of several reports commissioned at that time. Others focused on, for example, blended finance for sustainable land use, which was done by Cois Invest, and as well as another report done by Convergence, which looked at the broader blended finance landscape. So the main focus of the Blended Finance Task Force more broadly was really on mobilizing private investment for the Sustainable Development Goals. And is meant to really serve as the voice of the private sector to complement other parallel discussions that are going on in the context of, for example, the OECD, as well as within development finance institutions and multilateral development banks. And actually just last month, the Blended Finance Task Force launched a action agenda for blended finance, which was launched on the margins of the World Bank and IMF spring meetings. And their final action agenda drew heavily on CPI's work. So for our report, we had basically three main objectives. One was to really understand better clean energy investment opportunities, looking at both the size of the market and also potential investors. The second was to map the current blended finance landscape for clean energy. And finally, the third was to structure some recommendations about how blended finance can be deployed more effectively. Alexia, it seems like I can't move the slides. I'm not sure if there's a way to enable me to do that. Great, thanks. So to start with, what exactly is blended finance? The phrase is pretty commonly used. I'm sure you've heard of it, but we found that there's a lot of different definitions that are applied depending on who you ask. So for us and for the purposes of our report, we use a pretty simple definition, which is that it's the use of public or philanthropic funds to mobilize multiples of additional private capital. And we include both direct and indirect forms of blending. So direct would be that public or philanthropic finance that's blended within an investment vehicle or within a fund. But we also include indirect forms of blending. So for example, through the use of upfront support, for example, project preparation grants that are really outside of the actual investment, but we include it because we find that that can really be a catalytic use of finance to mobilize broader pools of capital. Next slide, please.
It doesn't seem to be working from, okay.
Great, thanks.
Yeah.
So blended finance is really a useful tool, or what we would call a solution set, to help overcome some of the risks and barriers facing investors. That's why it's really important. Whether those barriers are related to specifically new technologies or new business models, or in the context of the country that they're trying to invest in, blended finance can really help address any of those risks or barriers. And it's also one of the most important tools, probably alongside policy and regulation, that the public sector can use to catalyze private investment. And we found that blended finance can address risks in two key ways. One is through the demonstration of new technologies or business models in order to reduce the perception of risk and also build investor confidence. And the second is to actually transfer risks to another party, to the public sector, in order to encourage private investors to get involved. Next slide, please.
Sorry, it's been really slow. Hang on.
No worries.
There we go.
So we mentioned that we focus on the use of concessional capital from both public and philanthropic sources in blended finance initiatives. And some of you may already be familiar with the multiple types of concessional finance instruments that are available, but just to go over a few, we've listed some commonly used ones here. So concessional finance instruments can range from concessional equity to concessional debt, guarantees and other forms of risk mitigation tools, and also project preparation assistance or technical assistance. And just to walk through each of these to give a bit more definition of each, concessional equity is basically an investment capital provided to a company or a project in exchange for some form of ownership in that company or project, but which takes a junior or subordinate position to other equity investors. Concessional debt refers to loans that are offered at either lower interest rates or longer tenors than what is commonly available within a commercial market. Risk mitigation instruments like guarantees and insurance can help transfer certain types of risk, whether that's political risk or currency risk or performance risk, from the project to whoever is helping guarantee or insure that project. And then finally, project preparation support really refers to any type of support, which can be grants or technical assistance that's provided to a potential investment before it reaches financial close or before it's structured. Next slide, please. Thanks. So now that we've identified what blended finance is, why it's important, and what specific instruments can be used within a blended finance initiative, now we can get to why blended finance is important in the context of clean energy investments in developing countries. I'm sure many of you are already quite familiar with many of the risks that are associated with A, clean energy investments, and B, investments in developing countries, so I won't go through all of them, but I did want to show the risk framework that we used for our report, which was drawn from previous work that CPI did, and we used it in the context of measuring risks within the 3 specific countries listed here, India, Cambodia, and Kenya. We highlighted a number of risks that you can see here: political and social risks, policy regulatory risks, access to capital, etc. This framework can really be applied to any country, but we're just highlighting the 3 here that were used in the report. And basically what we found for these specific countries, some of the most important risks were really related to the risk of off-takers, so basically not having a secure buyer for the electricity, as well as currency fluctuation risk. So the fluctuation of currency associated with foreign investment or foreign debt. Next slide, please. So on top of the risks that I just mentioned, clean energy also has particular features that amplify, unfortunately, the risks that investors face. These include high risk at early stages of project development, high upfront costs, especially including legal, administrative, regulatory, and other costs, and also high transaction costs for investors, also long time horizon of investment, which often doesn't work with the time horizon requirements of many investors. So of the clean energy risks that we found that investors were most concerned about, actually related to, sorry, back one more, thanks.
Sorry.
No worries. Investors were most concerned about low liquidity, as well as the scale of many clean energy investments. So low liquidity meaning it's really hard to transfer clean energy projects quickly into cash, which is often a key requirement for many investors, as well as the scale of clean energy investment opportunities. So many investors, especially institutional investors, require large-scale investments to get involved, and many project opportunities, especially within developing countries, are too small in size to attract those types of investors. Next slide, please. So in our work, we took stock of 75 blended finance instruments that are currently working to mobilize private investment specifically for clean energy in developing and emerging economies. We found that the landscape of blended finance initiatives is quite rich, and already there's a strong track record being built. This slide shows a few of them, but there's of course many more that we note in our paper, and we'll talk you through a few of them just to give you some examples of how blended finance initiatives can be structured. But we also really encourage you to flip through our report and see the various examples we include, because there's a number of really interesting ones there. Next slide, thanks. So one example of a recently launched blended finance initiatives that we want to talk you through is Climate Investor One. It was developed by a private equity manager called Climate Fund Managers, but in partnership with the Dutch development finance institution, FMO. So the vehicle seeks really to reduce the high transaction costs that are often associated with renewable energy projects across the renewable energy project lifecycle. And this is done through establishing basically 3 interlinked funds that are focusing specifically on sub-investment grade countries. So a lot of the developing countries that are represented on the call today. So starting from the left-hand side, just to walk you through the structure, starting with the left-hand side of the diagram, a development fund is first financed entirely by concessional finance, with capital that will recycle back into the fund once successful projects move to the construction phase. So then the projects that make it to construction are then eligible for up to 75% equity finance from the construction fund, which is a tiered blended structure. So just walking through the different tiers of that structure, the top tier, tier 1, absorbs the first losses of the fund, if there are any. And the bottom tier, which is the senior tier 3, it's supported by a guarantee from the Dutch Export Credit Agency and will provide fixed returns to their investors. And then the middle tier provides the highest returns, but is also actually riskier than tier 3. So the fund to date has raised over $400 million with institutional investors participating in both tier 2 and tier 3. And once the projects are fully operational and in good standing, a refinance fund will be available to lower the cost of capital for those projects. The fund managers envision this model is scalable to a number of countries as well as to a number of other sectors outside of clean energy. So at this point, I'll now pass it over to Bella, who will walk us through the rest of the slides and talk a bit more about the role of governments in helping support blended finance initiatives.
Great, thanks so much, Jess. So I'll talk, as she mentioned, about a few of the results of the survey that we did on blended finance initiatives. So we reviewed, as just mentioned previously, 75 clean energy blended finance initiatives, and we wanted to look at the barriers that they were addressing and which ones were doing that most successfully. We wanted to understand what geographies and regions they were operating in, and to, from that exercise, then identify where the gaps are, so which barriers and which regions have not yet been prioritized. So there's obviously a lot of content there. This graph just highlights one of the findings from the report, which is around the regional breakdown of the initiatives we reviewed. And so you can see here that there's a significant focus on sub-Saharan Africa with existing blended finance initiatives, with 25 initiatives of the 75 we identified under implementation specifically there. Asia with 14 initiatives, and then a large number of initiatives that aren't region specific but focus on developing countries overall. And Latin America, Eastern Europe, and Middle East, North Africa have far fewer initiatives specific to the region. But what was interesting is that we also looked at the median size of initiatives, so how much finance that they had raised. And the initiatives for sub-Saharan Africa were smaller at a median size of $66 million US, compared to much larger ones in Eastern Europe and Southeast Asia. Most of the initiatives we looked at focused on lower income countries. 52% of the initiatives focused on lower middle income and 32% on low income. And so the remaining 16% focus on upper middle income countries. And again, like with the regions, many initiatives operate or invest in a combination of these countries. Next slide, please. So while our work for this report focused on clean energy, we wanted to recognize and emphasize that there are a lot of opportunities for blended finance outside of clean energy in other NDC related sectors. So in particular, there are a number of stakeholders and actors focused on developing blended finance initiatives and adaptation in cities and in sustainable land use specifically. And of course, while energy access is a subset of clean energy, in our report, we dealt with it lightly, but did not dive into depth on it, and we feel like there could be a lot more work done to dig into and develop effective models here. Relatively small percentage of the overall blended finance and clean energy initiatives focus on energy access, so we really felt it important to call it out here. So next slide, please. So to give you an example of a blended finance initiative in a non-clean energy sector, we wanted to talk to you about the Water Finance Facility, which is an adaptation-focused initiative. And this is one of the instruments, along with Climate Investor One, that CPI, our organization, has worked with in the context of an incubator we managed called the Global Innovation Lab for Climate Finance, which aims to identify, develop, and help launch blended finance instruments, and with a focus specifically on mobilizing private capital in developing countries. And so the Water Finance Facility was a instrument that we worked with in the lab in 2016. And its focus is to mobilize large-scale domestic institutional investment finance and to strengthen water utilities. So it's focusing on national level investors, so a Nigerian pension fund, for example, and focusing on water utilities in countries subject to climate-related stress and helping them to finance climate adaptation projects. So the basic premise is that a combination of concessional donor funding, national level government support, and an innovative financial structure that focuses on bond issuance can allow for significant private investment to be unlocked. And so the way it works is that a number of national level pooled bond facilities provide corporate loans to water utilities. So an institutional investor would buy a bond from a utility in exchange for the utility paying back the institutional investor a fixed amount generally on an annual basis. And then the utility takes that money and invests in in projects that help achieve climate benefits. And these national facilities are then supported by a global donor-backed World Water Facility that covers the portfolio in case of default and to help attract investors through credit enhancement. So the bond is targeted at local and domestic institutional investors in particular to reduce currency risk. So all of the currencies of both the investors as well as the revenues the utility receives are all in the same currency. This money then is used for utilities, in particular those with low access to commercial finance or only access to finance at poor terms. So the first facility is the first pilot is taking place in Kenya in partnership for concessional funding with the Dutch Ministry of Foreign Affairs and also the Kenyan Ministry of Finance, which is participating in the pilot. And they're aiming for a first bond issuance this year. And so the takeaway we want to leave you with this example is that national governments can help play a critical role in de-risking finance or private finance for climate adaptation. Next slide, please. So finally, we just wanted to conclude with some thoughts on what is the role of governments within developing and emerging economies to help develop blended finance solutions. So, above all, and this is something you hear frequently in the climate space, is that the key role of governments is to set strong, reliable policy signals for the implementation of NDCs. And this includes setting robust policies that relate to both mitigation and adaptation. And second, governments, again, on a big picture, macro level, can improve the domestic conditions to enable private investment. And that includes strengthening legal and judicial frameworks, strengthening policy institutional environments for both domestic and foreign enterprise, applying international standards and safeguards, fighting corruption, and supporting public infrastructure as well that can help facilitate private sector development. So those are kind of things that you hear frequently across the climate policy world and across the world of development in general. Specifically with blended finance vehicles, governments can support them in a couple of ways. One is through participating in multi-stakeholder partnerships. This can include a few ways. One way, for example, that we work with governments in the Global Innovation Lab for Climate Finance is they participate as members in our lab, and for our 2 labs that run in Brazil and India, those labs are supported by the national governments who participate on panels and participate in selection and development of instruments, which often requires going hand in hand with policy reform. Other ways that we've seen governments participate in the development of blended finance instruments is, for example, with the WWF's Landscape Finance Lab. They are developing multi-stakeholder partnerships at the landscape level for conservation and really focusing on partnerships around specific instruments, around specific problems or solutions within the landscape, and bringing in local and regional and national government at that point. And then finally, governments can get involved directly in blending using their own resources or channeled via international climate funds or development agencies. So this is what we showed in the example of the water finance facility, where the Kenyan government was directly involved with it through its Ministry of Finance by providing a guarantee for the fund. Similarly, we've worked with Rwanda's FINERWA Environment Fund, which is funding a climate smart agriculture blended finance initiative. And finally, many national development banks are key players in green financing and can certainly get involved in blended finance. So with that, I'll thank you for your attention and turn it back over to Alexia.
Great. Thanks so much, Bella and Jess, for that really interesting presentation. It just occurred to me as you were talking about different things that governments can do to support scaling up blended finance instruments, that, you know, putting pressure on some of the donors and MDBs and DFIs as well to channel more resources into new and innovative blended capital structures is something that can be really helpful. Because I think this is definitely something that the MDBs, the multilateral development banks, have struggled to support in the past. So I have a bunch of questions, but I want to open it up for folks on the phone to ask questions. So if you'd like to ask a question, just raise your hand and or indicate, you know, that you'd like to ask a question, or type your question in the box, and we can unmute you and let you ask your question. One question I had for you guys while we're waiting for folks to get their questions organized. Did you look at the application of blended finance in other sectors as you were kind of looking at this? Because clearly blended finance is not a new thing necessarily, but sometimes it feels like it's a little new for the climate finance world. And I'm just curious if, as you were putting together your methodology in the report, whether you were looking at other sectors that have deployed blended finance specifically.
Yeah, that's a good question, Alexia. So this report focused specifically on clean energy, and we wanted to look at the track record within clean energy specifically. So we didn't look at it too much. I look at other sectors too much. I would say that for better or for worse, actually, clean energy is probably the most developed around blended finance and its use. So we've so I think the organization Convergence, which is sort of a blended finance think tank, and also they do some funding for blended finance. They did do a report last year called The State of Blended Finance that looked actually at the sectors that blended finance was operating in, and indeed, you know, a large chunk of that was clean energy, but they did also identify blended finance being used in other sectors. I think education and health in particular are sectors that we've seen the application of blended finance in. So that's an interesting report if people are interested in a broader take on blended finance.
Yeah, That's great. I mean, clearly blending finance is typically used in large scale energy infrastructure projects in these markets a lot, right? So deployment of risk mitigation tools and vehicles and concessionary capital is how a lot of large scale oil and gas infrastructure gets built in developing countries. And just, I'm always interested and curious to see if folks have been trying to learn from those experiences and apply them in the work that we do. Future research topic maybe.
Yeah, absolutely. I mean, I think there's a lot of opportunity on, you know, and looking also at lessons learned from some of the other sectors that we identified that are NDC related, but we haven't had a chance to look at those yet.
Looks like we have a question from Vikal Sublock. Sorry, I'm probably terribly mispronouncing your name. Can you, you should be unmuted. Can you speak? Can you hear us? Looks like you're, oh, let me try this again. Can you hear us, Vikal? No? Try again.
I think he's going to have to press the unmute button in order to unmute himself. It's not something we can control from this end.
Got it. Vikal, are you on mute? Can you unmute yourself?
Yes. Can you hear me now?
Ah, yes, we can.
Oh, okay. Well, thank you, Alexia. Thank you, Mara and Jessica, for the presentation. I had a similar question like Alexia. I know that there's one question about blended transactions happening across different sectors, but I was also curious about blended transactions or blended finance vehicles actually happening over a range of capital structures. For example, most of the blended finance transactions or designs, instruments, or vehicles that I've seen are mostly somehow oriented towards debt capital. You see more on the debt side of capital deployment just because it's easier. It's easier to bring in commercial and institutional investors if you lower the risk. And from that theory, the blended transactions, lowering the risk makes perfect sense. I was curious if you've already also seen any kind of blended transactions or vehicles at the early stage formation of enterprises. So more from the perspective of enterprise creation in clean energy or other climate change related areas. I know MIA is one example, but I'm curious if you've seen more. Thanks.
Matt, do you want to talk? Thanks for that great question. And can you introduce yourself? Just tell us where you're from and which organization you're with.
Yeah, definitely. Sorry about that. So I'm Vikal Sablok. Alexia, you pronounced it perfectly. No problem with that.
Okay.
I work with the Global Green Growth Institute. It's an international organization, intergovernmental, which is headquartered in Seoul. So I was earlier in Seoul for around 1.5 years. Now I'm based out of Jakarta, and I'm helping the forestry and land use team here of GGI Indonesia on mobilizing more investment for the forestry and land use projects and programs here in Indonesia. Thanks.
Great, thank you, and thanks for joining. Matt, do you want to talk a little bit about the work you guys are doing on that front?
You bet. Can you hear me? Did I unmute myself successfully? Fantastic.
Yeah.
Yeah. So sometimes the challenge. So one thing that I've been working on here in Southeast Asia is an early stage project preparation facility. So as Jess and Bella outlined, and that's a focus on clean energies. It's one of the areas that we see some capital deficiencies and where the private sector market often doesn't want to go in because the risk is so high. I often call it dry hole risk. And it's actually at the project level, it's that high, and also at the corporate level, as you kind of just outlined. It's a little bit more of a challenge to blend finance. And the way I kind of look at that as a person who's kind of been in private equity and VC backed businesses for a big part of my career is, they kind of either succeed or they fail, over a timeline. And so sometimes it's very hard to find a blended capital that's willing to, be that much blend stock. So that's why you see more blending potentially happening at the kind of construction or asset finance level, because at that point, you're less looking about is the asset or project ever going to cash flow at all? You expect it to cash flow to some degree, but the real question is will it cash flow enough to make up the costs? And so you're kind of backstopping the debt aspect versus the equity aspect. What we're building here is called the Southeast Asia Clean Energy Facility, and we're basically providing concessionary capital at the earliest stages of project development, to really give project developers a little bit more runway when they're developing projects to deal with political risk, permitting risk, general market risk, so that they can get things to bankability. I haven't seen anybody yet do it for corporates, for just startup companies in the clean energy or sustainable landscape space. I think there's a lot of appetite for that, and it's kind of, I would say would be a concessionary venture model or growth capital model. But I think in the climate space, as a person who's been in it for 10 or 12 years, the whole venture-backed vision of how to start a business in this space is kind of, we've had some rocky times, so people are a little weird.
Mm-hmm. Yeah, absolutely.
Is that helpful?
Thanks. Yeah, thanks for that, Matt. And I wholeheartedly agree. I think one additional point just on this is that folks are blending capital kind of on both sides of that vehicle. So you blend the capital into the vehicle and often leverage, grant money or reimbursable loans, reimbursable grants off loans to help boost the return to your equity investors in a specific capital stack or in the facility. But then you're deploying a different type of instrument out of the vehicle. And one of the things that we're doing with the Microgrid Investment Accelerator is deploying capital alongside more conservative or risk-averse debt. So we're actually working with other debt providers to blend our capital on the investment side of things so that we can blend down their blend down our cost and their risk appetite and kind of meet in the middle. So I think there's a variety of different ways, and I agree that the early stage corporate sector is a place where we could really use some innovation, I think, because as Matt very aptly pointed out, the risk reward ratio in the infrastructure space isn't necessarily aligned for the types of capital that typically serve that very early stage risk. It's also important to note that that early stage ticket size, the amount of money that's invested in those early stages tends to be pretty small as well. And that's something that the larger pools of capital really struggle with. So it's almost impossible. It is impossible for a DFI or an MDB to do a $200,000 investment, which is kind of a typical, early stage seed investment in a new company. They really need to be moving multiple millions. And that's why these intermediary vehicles can play such an important role. Are there other questions from folks in the audience, or Bella or Jess? I don't know if you guys have thoughts on that question either, or both.
Yeah, I mean, sure. Just to second or agree with what you said, I mean, that was one of the key gaps we identified in the report was for, say, blended equity for early stage companies in particular. There's a lot of motion right now, including what Matthew's working on for early stage project development. And from what we could tell, it seems like in particular for early stage companies, it was even doubly hard to access equity or access risk capital. So we would certainly like to and welcome further work on that in particular. There's an organization in the US called Prime, which is focusing on bringing philanthropic funding into the early stages of clean technology development, and is addressing similar risks to the ones that we've been talking about. So a model like that could be really nicely kind of translated to developing country contexts.
Mm-hmm. Yeah, absolutely. And I definitely needed work in the kind of early stage incubation and innovation ecosystem in developing countries. I wanted to just point to folks to a couple of resources that we use and have found helpful. One is CPI's website, but also specifically if you're interested in seeing a summary of the report or reading the report and downloading it, it's available on our website. Convergence is also a wealth of information and early stage kind of project seed funding for blended finance approaches across a variety of applications, including NDC and climate finance. It's a Canadian nonprofit that was seed funded by the Canadian government and established just a couple of years ago. They've really been taking a very active role in both matchmaking into blended capital vehicles and investment opportunities, and just broader kind of market education and information. We also, through the LEDS GP, have something called the Remote Expert Assistance on LEDS. So if countries are looking for support in doing some preliminary design work on a blended capital vehicle or facility, we can help identify expertise either regionally or internationally that can come in for a fixed period of time to provide support on that. And the LEDS GP Finance Working Group also did a resource guide last year for NDC Finance that is a fairly comprehensive categorization of a lot of the different reports and tools and financial resources that are out there on NDC finance strategies broadly. It's actually a really useful document. It's linked on the NDC Finance website, or excuse me, the LEDS GP Finance Working Group website, so you can go check that out. Please also let us know if there are resources that you use and like that we should be aware of, and let us know if there are additional kind of specific topics related to blended capital that you'd be interested in exploring further. So with that, we will conclude this evening's webinar. Thank you very much for joining us. Big thanks in particular to Jess and Bella for taking time out of their busy schedules to share this work. And we will look forward to ongoing conversation and collaboration. Thanks so much, everyone. Have a great night.